Good morning, everyone. Welcome to Mortgage Monday on May 21st. Today's topic is adjustable rate mortgages. I've got kind of a short presentation for you today because this topic is somewhat simple. But again, if there are any questions during the presentation, please save them for the Q&A at the end. You can either type it up or you can just speak out and I'll answer your question. And with that, here we go. So adjustable rate mortgages, or ARMs. What is an ARM? Well, an adjustable rate mortgage is a 30-year mortgage with amortized payments that has an introductory interest rate that lasts a set period of time and adjusts annually thereafter. After the set time period, the interest rate will change, and as a result, so will the monthly payment. This is very much unlike the popular 30-year mortgage that has a fixed rate with amortized payments that do not change. However, the ARMs fulfill a need in the marketplace for many borrowers with certain financial situations or goals. Examples of ARMs are the 10-year ARM, where your interest rate is set for 10 years, then adjusts once annually for 20 years. The 7-year is similar in that it's fixed for 7 years, the rate, and then adjusts annually for 23. The 5-year ARM is fixed for 5 years, then adjusts annually for 25 years, and the 3-year ARM is fixed for 3 years, then adjusts annually for the remaining 27 years. General advantages and disadvantages. Well, the initial interest rates for ARMs are normally lower than a fixed rate mortgage, which in turn means the monthly payment is lower. If you only plan to stay in your home for a short period of time, an ARM loan might be advantageous to you because you plan on moving or selling your home before your initial mortgage rate adjusts. The loans typically do not have prepayment penalties if they're paid off before the interest rate adjusts, which makes them more financially attractive. They're also a good option if you expect your income to increase in the future. You might feel comfortable with the idea of saving money now by having a lower monthly payment and also be comfortable with making higher payments in the future when your income rises and your ARM adjusts. ARMs are generally considered riskier because the interest rate will probably go up after the initial fixed rate period ends. Therefore, when reviewing 3- and 5-year ARMs, lenders will qualify you at a higher interest rate, typically 2% above the initial start rate, so they're more comfortable with the borrower being able to afford a higher payment should it rise. For the 7- and 10-year ARMs, the lender will typically just use the start rate to qualify the borrower. So what happens when my ARM loan adjusts? You can determine how much your ARM's interest rate is going to increase or decrease after the initial fixed rate period ends based upon the index and the margin it's tied to. The index value is variable, while the margin value is constant throughout the lifetime of the loan. An index is a benchmark variable interest rate that is published regularly and available publicly. Typical index rates that are associated with ARMs are LIBOR, which is the London Interbank Offered Rate, the COFI, which is 11 district cost of funds, the T-bill, the U.S. Treasury bill, and CMT, constant maturity treasury. A margin is a fixed percentage rate that you add to your index rate to obtain the fully indexed rate for an adjustable rate mortgage. The lender determines the margin and will disclose it on the loan documents, as well as disclose to you what index your loan is based on. For example, if your index rate is 3% and your margin is 2%, then your fully indexed interest rate would be 5% when it adjusts. The ARMs will have a cap on the interest rate for your protection. There is an annual cap and a lifetime cap that prevents the rate from adjusting over this amount. The annual cap may be 2%, which means that the rate cannot go up or down more than 2% annually from the previous rate, even if the fully indexed rate would make it so. For example, the initial fixed rate is 2.5%. The fully indexed rate will be 5%. The annual cap is 2%, so when the rate adjusts, the highest it can go up to is 4.5%. The lifetime cap could be 5%, which means the interest rate would never go over 5% from the initial rate over the life of the loan. Another example with that is the initial rate is 2.5%. The interest rate over the life of the loan can never go over 7.5%, which is 5 points higher. So that's basically it when it comes to ARMs. If you have any questions, please let me know. And if you'd rather not mention them here, just shoot me an email and I'll be happy to reply or give you a call and discuss it. Well, okay, no questions at this time. So thank you very much for tuning in today for Mortgage Monday. The next Mortgage Monday will be June 4th. And the topic's yet to be determined, but I'll let everybody know what it is. And thanks again for calling in. Have a great week. Aloha.